Hey everybody, welcome back to another episode of A Millennial's Guide to Real Estate Investing. Today on the show I have Sam Bates. He started investing back in 2010. He started in single family homes and being a limited partner in a large apartment building in Houston. Is it in Houston or just Texas? Okay, cool. And now he started Trinity Capital Group with him and two other partners. So thanks so much for coming on the show.
Well, thank you, Antoine. I appreciate you having me on and look forward to talking to you.
Absolutely. So tell everybody, I guess, a little bit of your background and how you got started in real estate and real estate investing.
It started off when I was young. I actually started working for my parents when I was about 11, and I started investing that money at that point. So I always knew I wanted to help people reach financial freedom, and I went to college and I got my undergraduate in financial planning, I got my undergrad in finance and worked at UBS out in LA and helped high net worth individuals put together portfolios. And then I went back to grad school and got a master's in financial planning. But
Nice.
during that time frame, that's when the market crashed, and I felt like I couldn't advise people to invest in a product that I had absolutely no control over. And after grad school, I went and I started consulting at a company that way. So I decided to start investing in real estate, and I knew, I met a guy who introduced me to a couple people that were investing in apartments. So I decided to put some money as a limited partner in an apartment, and then also started buying single family. Outside of that, the apartment investment didn't pan out quite as well as I hoped and quite as well as it should have, given the time frame we bought it, the market demographics.
Yeah.
So after that, I thought the single family route was really the only way I could get into real estate.
Yeah.
I didn't have the capital or really the resources or network to do apartments or buy apartments, do apartment syndication. So from 2010 to 2013, I bought 17 single family homes in some capacity. It was either buy and hold, flip. I did one spec build. So that was my, introduction into real estate.
Yeah. Awesome. And how were you buying all those single family homes? Did you have a W-2 job and you were just saving money and you buying the buy and holds? How are you financing that?
Yeah, luckily I had a W-2 job, and in 2010-ish, being in Dallas, the market hadn't recovered, so I could pick up single family homes for $60,000, $70,000, $80,000.
Yeah.
And then you could put in 20, 30K in rehab. Some of them I didn't even need to put rehab into them, but a lot of them I bought with hard money loans. So I did basically the Burr strategy before it was called the Burr strategy.
Yeah.
And was just able to pull out the cash and then move to the next one.
Awesome. Okay, cool. And then so you did those, you started with that, you were LP in a deal, it didn't go as well. You started doing the single family homes. And then what made you want to get out of the single family home and go into, because you did all that, but then you wanted to get into multifamily. So why multifamily, and what wasn't working with the single families?
Wasn't working with a single family is just how long it took. And honestly,
Yeah.
in 2012 and 13, I was still working my job. So early on, I was able to get the deals from MLS. I was able to buy them on auctions, and it just started to become more concentrated with investors. So deals were harder to come by, and I didn't have the time or energy to market for deals myself, working a full-time job. So I started looking around and just seeing what would be the best strategy. And with multifamily, I like it for a couple reasons. Mainly is you can force appreciation. You don't have to rely on the market to dictate the price. You can increase the price depending on how you run the business. And then also it's a lot easier to scale than a single family home. You can buy 50 units or 100 units, and it's just as the same process as it would be to buy one or two single family homes. And I know you can create funds to buy single family homes, but I feel like also from a capital raising standpoint,
Yeah.
go to an investor and say, hey, I have a asset or an apartment, it'll provide X return for expected number of years. And I think they're a lot more inclined to invest in an already performing business or basically a business that you're going to create instead of a fund that you are going to buy maybe 100, 200, 300 houses, but you just don't know when or the exact return.
Yep. Okay, cool. And then so you realized you wanted to get into multifamily. So what was your next step? You had the W-2, you had those 17 single families, but how the hell are you going to get out of that rat race and go, do something in multifamily? So what was the next steps for you to achieve that goal?
Well, ever since I moved to Dallas in 2008, and really I've been networking with people in real estate ever since I got here. And I had some broker relations, so they started sending me deals. And I looked at a few, and then luckily I just stumbled across a person I used to work with at one of the consulting firms, and he was doing essentially the same thing. And he had a similar track record as I did with buying single family, ready to move up to small multifamily, either 10 to 20 units. And we decided to partner and come together we felt like we complemented each other well and we knew each other's work ethic. So we could pull our resources together and buy something larger. We thought that was a great idea and we tried it for a year or two, but since we didn't have a track record,
Yeah.
really most of the brokers were afraid to give us deals, or we just weren't offering maybe the highest dollar that we needed to get the deals. So we had to re-strategize and figure out how to get into the multifamily industry. Essentially, they always say the first deal is the toughest, and it definitely was. So he knew a guy through his church that was in construction for 20 years at that time, and we formed a partnership, and it's just kind of went from there.
Awesome. Okay, cool. And then at what point did you quit your job then? Did you guys get something under contract and you were like, all right, first deal we get going, I'm going to quit my job? Or how did that whole story play out?
No, definitely not. I'm ever since I was little, I've had a fear, or I've had security issues, and I've always had a fear of money, like not having enough or starving or something. So I still work the same job I had for really 2.5 years or so.
Yeah.
That after we had already started the company, and by that point we had worked on 8 or 9 projects. And in 2018, I felt like, especially towards the end, we picked up a lot of speed, and just a lot of things that we had put in place in 16 and 17 were coming to fruition.
Yeah.
So, and the company I was with had been bought out twice in a 6-month period. So I was reporting to the CFO of the new company that lived in the Netherlands. So it was not ideal. And at that point, there's just a lot of influences that made me decide to go off on, or leave the W-2 job and just focus on real estate to try to grow our business.
Awesome. And then you mentioned networking. So how were you networking? What have you found was the best way to network with other people in real estate?
Well, I feel like since the DFW market's been so hot the last 10 years, there's meetup groups, there's real estate events, REIs, pretty much every night of the week. And you can go and just meet anybody and everybody. And then I also did a lot of reading and learning, probably the first 3 or 4 years in real estate. And so I think that was a big part of it, and being able to sound confident and exactly know what you're talking about when you're talking to people, because there are a lot of big players you can meet at these different events, but there's a lot of newbies. And so I wanted to give them, to show credibility that I knew exactly what I was talking about.
Got it. Okay, cool. Awesome. And then your current company today, so are you guys only doing stuff in DFW market, or are you guys doing other things in other markets? Since, like you said, DFW's blown up and there's a ton of people all across the US that are looking at your market. So are you guys, you guys are there and you probably have the leverage with the brokers because you guys can have beers with them after work every day. But, are you still looking in the DFW market, or are you guys expanding?
We're looking in a lot of different markets. We haven't actually been able to get anything in Dallas or
Oh,
Fort
wow.
Worth. One of my partners lives about 20 miles west of Fort Worth, and we've done a 200-acre lot development there. We've built an apartment, and we're starting our another apartment development, which will be 252 units total. But that's the closest thing to Dallas Fort Worth.
Okay.
We have a property in Kerrville, which is about 5 hours from Dallas. We have a property it's a suburb of Memphis, Tennessee. It's actually in Memphis, Mississippi. And then I have an apartment in Wichita Falls, which is about 2 hours from Dallas.
Okay.
So that's another reason. And at the time, I didn't really realize it when I was making the transition from single family to multifamily. But with the technology we have today, and the apartment has in their P&L, they have line items for third-party property manager. So you can invest fairly a lot easier than you could 10 years ago because they have somebody that's boots on the ground. They're working 40 hours a week at the property. Then with the technology you have, you can see what's going on, or just a quick flight or quick drive. So it's not too hard. I would love to have all the apartments in Dallas, but with the cost and just competition, it makes sense, at least for us, to go to different markets.
Okay, got it. And can you explain what a 200-acre lot development means?
Yes, it was just a raw tract of land, and we turned it basically into a subdivision
Oh,
where
got it.
we had to put in utilities, roads, we had to clear some of the trees, and then we changed, or we plotted it for 95 acres or 95 lots in the 200-acre development.
Got it. And then you sold it to a developer who's then going to build like single families.
Yes, we sell it to builders, or we'll sell it directly to the homeowner.
Okay, got it.
They can select the developer or builder they want.
Got it. Okay, cool. And then for the markets that you guys are investing in, do you guys have like a minimum? You mentioned a couple of areas that I know. I know the Mississippi place that you're talking about. Do you guys have like do you guys look at any like minimum population size for those areas that you're doing? I know you're doing then the 252 unit development, which is a little bit outside of DFW. Do you guys look at any minimum population, or are you guys more focused on job and job growth no matter what population is?
Up until this point, we really haven't focused too much on population. We look at the job market, and
Yeah.
honestly, the demand. Before we've invested in any city, we'll go in and have third-party reports that show the demand for apartments.
Huh.
And the two places we've invested or built in, their supply is there's a
So much
huge amount of
demand.
supply, and the demand just isn't being met.
Yeah, yeah.
Yeah, I misspoke. Sorry. There's large demand, but there's just not any
Not enough
supply.
supply. Okay,
So,
cool.
but I'm trying to shift this more to the BC class properties, the value add, and in those type scenarios, we're looking more in higher population cities.
Yeah.
Obviously, we look at other graphics, and it has to be influx of people moving in, the job market, just
Got it.
different factors from an economy standpoint.
Got it. Where do you where do you guys get all your reports? You mentioned like third party reports. Where are you is it just like the CoStar and you're downloading reports off that, or other websites?
No, it's different vendors. Like one of the banks required us to get a third party report, and they
Oh,
hired out a company called BBG, which they specialize just in real estate analytics. So we report, and it gave us, I think, 200 and some odd pages of data. And after that, we realized that was something that we should do for all of our developments because a development has a lot more risk
Mm-hmm.
than just going and buying already existing property. So we definitely we definitely look at developments in a little different light and make sure that there's a need, but we can't go into Dallas and compete against Trammell Crow or Gables or some of these big players that have been around for 40, 50 years. So we feel like we found a niche in tertiary markets, and at this point we've done really well.
Got it. Okay, cool. And then are you guys seeing for like an outlook? Like you said, like the developments are super risky. That's why like I have somebody presents me a plot of land. Oh, you can build. I'm like, hell no, I'm never doing that. So why, are you guys thinking that, with the way we are in the market that you guys are going to keep building? I guess if you keep on buying those reports and you know that the demand is there, then it could make sense. But my thing too is always in those tertiary markets or even smaller than that, like developing and then the market does crash and those jobs do leave, then what is going to happen? So are you guys thinking of staying in the development side of things, or are you guys looking to kind of change your strategy because of where we are in the market?
We've decided to change our strategy. I think part of it is where we are in the market, but we also feel like it's just a long process
Yeah.
to go through the development, and just to build it can take 18 to 24 months, and then a lease up can be 6 months or 9 months, and before that you have to go through the loan process and approvals with the city. So at this point we just don't feel comfortable continuing that, and we have two going on right now, so our resources are starting to get diminished, and we don't there's obviously a lot of workers we can find in the DFW area, but it comes with a premium.
Yeah.
And one of our core competencies that we have over other people is we feel like we can build a same product for usually a lot lower price, just relationships with these same contractors for 20 years or so. And he knows them, and he knows how much they can do and what they can do at a time.
Got it. Okay,
So
cool. Awesome. So more moving into then like a C or B class value add and a little bit bigger of a market moving forward.
yes,
Yeah.
definitely. I've been looking at all the Texas markets, some of the Florida markets, and a few other markets throughout the Southeast, but I'm trying to get a concentration of apartments in at least one market, and I've been focusing a lot of effort in San Antonio.
Okay.
I think it's a great Texas market. People are moving there. It's relatively close to Dallas, and it just doesn't have quite the competition, and the price per unit, or the entire overall price isn't quite as high as Dallas is at this point.
Got it. Okay, cool. And then what are some things when you're doing that research for a market, what are the couple of things you look for to find a market?
Well, I think job growth is key. If they aren't producing jobs, then we don't want to invest there. And also how diverse the economy is. Dallas or DFW has a economy compared to Houston, where it's been historically it's been concentrated in oil and gas. They have now had a large influx of healthcare and hospital systems, but it's still more of a market that we don't want to go into, just because if oil and gas tanks again like it did back in 13 and 14, they're going to experience a possible depression
Yeah.
again, depending on how severe the turn is in oil and
Yeah.
gas market. So we look at those two characteristics. We look at just how many people are moving into the market. I know from a job growth standpoint, that usually indicates if people are moving into the market. And those are the three main key characteristics
Okay,
that we
cool.
look at.
Got it. And then let's talk about the syndicating part of it too. So raising money, how have you been able to raise money? How do you get in front of investors and convince them that you're the right syndicator to do the deal?
Luckily, all of the funds we've raised so far has been through relationships that we've established over the years,
Wow.
through either business relationships, acquaintances, We have a few family members that have invested, or just now we're starting to get referrals. And the first couple deals we did, we felt like we were really generous with our splits. Like we didn't take any acquisition, disposition, asset management fee, and we did just straight up 80/20. Um, so that I think incentivized and enticed investors to give us a shot,
Yeah.
honestly. And the last couple of deals we've done, we've changed it to more traditional, what a private equity would look for, with the 8% pref, 70/30 split. But we haven't done any type of waterfall or hurdle. We want to just, we don't want to
Make it
really
complicated.
complicate. Yeah, we don't want to make it complicated for the investors, and also we keep getting repeat investors, so
Yeah.
we want to try to
Yeah.
incentivize them and just thank them for giving us a chance early on. And even if we hit a 15 or 18% IRR, we think they should still get that same split.
Yeah. Yeah, I agree too. Yeah, I'm looking at getting into syndications this year. That's why I ask. But yeah, I mean, for us too, we were not going to take any acquisition, no disposition, no asset management, but just do like a 70/30 split and keep it super simple. Like, I don't like all this complicated stuff. If the deal does better, everybody benefits. And
Yeah,
for me, even
I
removing the pref too was something. My deals are a little bit smaller, like, $1 million deal or $2 million deal. So it's like not worth all the accounting mess that I have to deal with.
I agree. And the first time we introduced the pref, we had a lot of investors question it, and they didn't quite understand it.
Yeah.
And I spent probably at least 5 or 6 phone calls talking to people, just explaining what the prep was and telling them that it's actually a benefit to them. And after that, they understood it, but it was still kind of a complicated
Education. Yeah.
situation. Yeah,
Yeah, and
education is
it
key.
actually benefits the investor though. Maybe after you explained it, they actually understood. But yeah, it benefits the investor over the GP, because the GP then gets paid after they've made that return. So, actually, why don't you explain what a pref is, preferred return?
Yes, a preferred return is usually anywhere from six to, I've seen it go up to 10 or 12%, but typically it's 6 to 8%, and it's a 6% or 8% return on their initial investment. So if they invested $100,000 for easy math, they're guaranteed a 6 or 8% return on their money before the sponsor receives any distributions or any money on the deal. So it just incentivizes the sponsor to make sure the deal performs, because if they aren't reaching that 8% threshold, then they aren't getting any money for the entire work that they've done for 3, 5, 10 years, however long the whole period is.
Got it. Okay, cool. And then can you explain a waterfall?
Yes, a waterfall calculation is a calculation that you basically put, and this is another term, but hurdles. And for just simplicity's sake, say if you have a waterfall at 12%, then say it's a split of 70/30 up to 12%. Then it goes to 60/40 or 50/50. It A lot of investors and syndicators, they have a lot of different hurdle rates or waterfalls, so it can get complicated. But
Yeah.
that's essentially the same thing, is that there's just different metrics on a return perspective. If the syndicator meets them, they get a larger portion of the deal than
Yeah.
the limited partner.
Yeah. Yeah, it's pretty much a way to incentivize the GP to do a amazing job, because they're going to get an even better return. So it's kind of paying dividends to the GP for making the deal spectacular, right? So, the higher the
Yes.
returns go up, the more the GP makes, which is going to incentivize that GP to really crush the deal and, make it a 40% IRR or whatever the case is.
Yeah, exactly.
Okay, cool. Awesome. And then, so what do you guys, over the next 5 years, I mean, you're starting to get into, I know you've done a lot of projects like less than 100 units, but now that with the change in philosophy, are you guys looking to kind of scale up and do more deals in different markets and do like maybe, since it's going to be value add instead of like ground up development? And I know you're doing 252 development, so that's a lot of money that you must have raised for that. But are you guys looking to do bigger deals, or is that kind of like 50 to 100 unit range your sweet spot?
We're looking at deals. Actually, this year I've only analyzed deals in usually the 10 to 20 million dollar range.
Okay.
Right now, we have a deal under LOI in San Antonio that's right around the $15 million range. I can't go too much into it,
Yeah.
uh, um, but that's kind of the sweet spot we're looking for now. And hopefully that'll grow. And after we get a few 150 to 250 unit deals and we feel like we
Yeah.
can manage those successfully, then we might start looking at bigger deals. I know once you get into 300, 400 unit, you're starting to play with more institutional investors. So that changes dynamics of going against a lot of the mom and pop or the syndication groups that
Got it.
have spawned over the last 10 years.
Yeah. And then in terms of property management, how are you guys using one property manager for all of these portfolio except for the Mississippi one, or are you guys different property management companies?
We have different property management companies since some of our properties are 5 to 7 hours away. It didn't make sense to use the same property manager.
Got it.
We just felt like some of the property managers that we use or they don't want to be in different markets. So before we buy anything, we'll talk to property managers and just vet them and see which ones we click with the best. And then once we get to the LOI phase, we'll also have them, or once the LOI is accepted, we'll have them underwrite the deal and see if we think their underwriting matches up to what we've underwritten, and if there's large disparities, why. But we have had some good success with property managers, but I've actually had to fire a property manager, even though they were doing well and they were actually performing over budget.
Yeah.
I felt like they became lackadaisical, and we were able to bring in 5 corporate leases on an apartment, and the corporate leases were 2 to 3 times higher than normal rent. So I think they were resting on those laurels because income looked great, but I felt like a lot of meat was left on the bone.
Yeah.
And it was a tough decision, but I think it was the best decision. And that just happened in the end of April, so time will tell.
Yeah.
But from our standpoint, it was the best decision. And when we told our investors, they were all happy. And some of them said we would have made that change months ago.
Oh,
So
wow.
yeah, and that was kind of hard to hear because I feel like we have a fiduciary responsibility to our investors,
Yeah.
and I want to do the best we can. But and NOI was going up every month, and so I felt like maybe we could just see where it goes. But after a couple months this year, I knew the change was imminent and needed to be done.
Got it. And then how are you finding those property management companies? Just Google and then you call all of them, or what's the best way you found to find those? Because it's harder to find them for multifamily.
Yeah.
I found single family, they're all over Google, but the multifamily ones, the ones that are killing it and doing a good job of just focus on doing the good job. So how have you found them?
I think a combination of things. Since I've been networking for over a decade, I've heard different names of people, and then I will get referrals from brokers or other apartment
Okay.
owners. A couple of brokers I'm really good friends with now, so they'll give us, and just talking to, honestly, apartment owners, they'll tell you the good, bad, and ugly. Every apartment or third-party manager we've worked with, we request referrals, and obviously the referrals are going to speak highly of them, but they will tell, or at least in my experience, they've told us some of the bad things or some of the things that the property manager needs to work on. So going into it, we know kind of what to focus on and what might their weaknesses be to try to help bolster that and
Got it.
improve the performance.
And how are you reaching out to the other apartment building owners to get that feedback? If you don't get the referral, is it just through your networking? A couple of the investors, you ask them?
Yeah, it's just
got
through networking. Luckily, through some of the mortgage brokers we've used. They'll have different, basically, owner meetups quarterly
Got
or
it.
through just meetups or networking. You meet different owners,
Yeah.
or at least I've been able to, and I've been able to stay in contact with them and ask them what their opinions are.
Got it. Okay, cool. Awesome. And then what's the best way for people to get in touch with you?
Way would be through email, and it's sam@trinitycapitaltexas.com. I'm on Facebook and LinkedIn, but I really never go to social media. That's actually that's actually one of my goals this year is to have a more social media presence, but it
Yeah.
just hasn't happened yet,
Yeah.
quite yet.
Gotcha. Awesome. Well, thanks for coming on the show, Sam, and hope to have you on maybe in the next year or something when you test out the new strategy, and hopefully you guys can have success with that, and have you back on. And yeah, thanks for everything and sharing your insights and your story with the listeners.
Well, I really appreciate you, Antoine, for having me on and getting to share my story. And hopefully, I was able to provide some information to you and your listeners.
Yep, absolutely. Thanks so much.
All right, thank you.